Hi, everyone. This is Matt Williams from JTM Williams Capital Management. Today, I wanted to do a brief review of 2025, go over a few charts, relative strength graphs, risk appetite ratios, and see how asset markets are positioned going into 2026. Now, before I begin, the indexes, ETFs, securities, tickers I'm highlighting here are an endorsement or recommendation to buy and sell. They're purely just charts I like looking at on a daily, weekly, and/or monthly basis to get a good representation of the parts of the capital markets I wish to review and analyze. Now, with that out of the way, let's take a good look at 2025, see where we're at, how we got here, and where we could be going. So I'm just going to share my screen real quick. All right, so what we're going to start off with here is just a little over a one-year chart of the S&P. So the way I looked at 2025 is you could really break it down into several parts. We came into the year really going through a little bit of a sideways move after a pretty big, reaction here off of the, summer low and after the 2024 presidential election. Uh, where things started to rotate, I would say was here around this high in mid-January. There you started to see some of the more risk-on parts of the market start lagging some of the more risk-off parts of the market. And I'm going to illustrate that here, looking at some sectors and factor analysis here in a bit. So, this right here, I effectively say would be part one. The market made a new high here approximately February 18th of the year. And then after that was when the market got a little bit of a shock here from what you could call the tariff tantrum. So we ended up having a little bit over a 20% correction with a little pause with a dead cat bounce right in the middle. The market had quite a panic. VIX got above 60, and we ended up bottoming on April 8th before there was a little bit of a backup of the tariffs. Now, even though the market bottomed on April 8th, what I kind of consider the bottom of the market was here on April 21st, which was a Monday. We came into the weekend and really didn't look like things were that negative, coming out of the weekend. Had a really nasty open to the day, continued it into the afternoon, and then around 3 p.m. It seemed something came out and we stabilized, and we ended up closing. I think it was around 50 or 60 S&P points off the low, and really since then, that's where we had this rip roaring rally where there was kind of a backing off of some of the worst parts of what the market perceived as the tariffs. Right here in mid-May, over the weekend, there was a trade discussions with China that came out much more favorable than the market was pricing in. That created this big gap, and then after that, it's just been off to the races. Now, again, I'd say this is part one, is this consolidation here. Part two was the down move from February 18th until what I'd call around April 21st. And then from April 21st until around Halloween, that was, what I consider part three. And then since then, it's part four. Now, not equal quarters, but again, I just think there's some periods here. If you look at intermarket relationships, it kind of shows, okay, the nature and the, what the market's looking like internally can be, kind of divided into these four parts again. So part one, part two, part three, and then part four. So I'm going to go to the next one where let's take a look at some of the sectors. I'm going to show you some, kind of how I, look at things on a, again, daily, weekly, and monthly basis. And we'll go from here. So next, this is going to be looking at the main sectors of the S&P. So here's a chart of the S&P. What you're going to notice in some cases that some of these look an awful lot like the S&P most of the time. Normally what you want to see is the risk on parts of the market, your technology, your communications, your consumer discretionary, your cyclicals. You want to see those leading, outperforming the market. Those are signs of a good sustainable uptrend. And obviously the opposite, what you're going to see is here during this down move, that took place, these 2 months, you're going to notice that some of the more defensive parts of the market were, what outperformed and almost effectively ended up looking like the inverse of some of the offensive parts of the market. So, here's the S&P 500. Now, the largest sector, in the S&P right now is technology. And, even from there, you could almost pull out, the semiconductors where even though they're a sub-industry group, they've effectively become their own sector where between Nvidia, Broadcom, and a number of the others, the roughly 12 to 13% of the S&P could actually be higher now. But if you took that out of the technology sector, that in and of itself would be the second largest sector, only behind technology itself. So if you see here, we have this down move. Now, one thing I just want to point out is, even though the S&P made a new high, here from January to February, technology did not. So that was giving you a little bit of a warning potentially that the market, there was some, institutional money, under the surface that was starting to take some chips off the table. They thought potentially that there was a, chance for a little bit of a risk off event. And obviously that's what ended up happening. So we'll continue going down. So, next, healthcare. Healthcare is a little bit more of a risk off sector. Sometimes if you take some of the biotechnology stocks in there, it could be considered risk on. But, again, you'll see that this almost looks like the inverse of, technology here this year, led during the market swoon, underperformed, big downtrend while the market recovered. And then, here, like I said, kind of around, September, Halloween, there started being a rotation in the market. Consumer discretionary. This is the parts of the market where, if the consumer is, confident, normally you want to see the consumer discretionary stocks. That's your, home builders, your Amazon, your Teslas, the ones where obviously, like if, people are willing to spend, they're going to outperform you. This is another one you want to see, contrary to, let's say, consumer staples, where if people get in defensive mode, people are going to rush into staples. We'll go down next to consumer, communication services. This is, your Googles, your Metas, your Netflix, your Disney's, Verizon's, AT&T's. Again, typically, a risk-on sector. Again, there's two stocks in there that are considered part of the Mag 7, which are around a third of the S&P now. These actually ended up both outperforming, during the downturn. Had a little bit of a consolidation, made a new high, and then have actually been selling off. So that's just one thing to keep an eye on. One thing I just want to go back here to tech is what's interesting here is even though the S&P didn't quite make a new high, or let's say maybe it did by a few points here, here in December, technology did not. So again, that's not at least the way I look at things, that's non-confirmation of a new high. That's a big flashing yellow light. That's not, hey, everyone sell everything and get out and start hedging and shorting the S&P and buying volatility. No, that's just something where want to basically keep on your guard, just in the event that, if things start reversing, price is the biggest thing we need to pay attention to. So we'll keep going down. Financials, again, financials, outperformed during the, market downturn, underperformed here. Now, again, they happened to bottom, relative to the S&P right around the time that technology and some of the offensive parts of the market started, started to reverse. Now, one thing, just in terms of breadth, before I get to some of the next charts, one thing you'll notice here with tech is there was a point in time, here up until, let's say, around like early November, late October, that I believe the technology sector was the only sector in the S&P that was outperforming the S&P over a rolling 6 months. Now, again, part of that is, it's one third of the S&P, so just it's a math issue at that point. If it's leading, like that, it can carry the whole index up. Now, continue, we'll move on. We're going to go to the, next one here. So we're going to continue going into some of the other more defensive and defensive sectors of the market and some of the ones that from a weighting perspective are a little lower. So, real estate, again, risk off, outperformed, during the market downturn on a relative basis and has been underperforming here ever since the market bottom. Industrials, these happen to be, pretty strong here, throughout the first half of the year, and have lagged. But again, part of the rotation that's been going on, you're starting to see some of that money come back in. Consumer staples, and again, what I would like to point out is here, consumer staples on a relative basis bottomed in mid-January and started leading well before the S&P as a whole ended up topping out around a month later. So again, market does give you some clues, from time to time under the surface where the big money started to make, rotations before the broad index will, either go up or down, depending on what your perspective is on things. Next, utilities, same thing, risk off, lagged, and then obviously now you're almost back to 52-week relative lows. Materials, this is a sector a lot of times I'd rather look at metals and mining, than maybe necessarily the materials sector as a whole. That's just a preference of mine. Energy, crude oil continues to be in a consolidation to slightly down, or excuse me, downtrend. So until then, the Exxon, Chevrons, Occidentals don't seem to be able to, catch much of a bid, at least on a relative basis to the S&P. Next, I'm going to go into sub-industry groups. So I think I mentioned earlier about semiconductors. Semiconductors right now, that's almost become the modern transportation, index in terms of, Dow theory. Those are, everything now effectively runs off semiconductors. NVIDIA, which is the largest component of this index, is the, kind of darling of the whole AI trade. And, as you'll see here, one thing that I thought was interesting is, again, S&P made a new high from mid-January, mid-February. Semiconductors on a relative basis did not. Uh, even though the semiconductors actually ended up bottoming slightly before the S&P did, you got a little bit of an early warning sign here. And again, as long as this is making higher highs, higher lows, it's hard to be too bearish on the stock market. So again, there's some yellow signals. You're flashing yellow lights right now, but again, on balance, we'll continue looking at some things. Software again. This is your Microsofts, your Adobe's, Palantirs, Oracles. This is a part of the market I would prefer to see outperforming right now, but obviously it's taking quite a dive on a relative basis. The bank stocks, again, we've had quite the rotation, from growth into value, here over the last 2 months, and the banks, which traditionally considered part of the value market, have started outperforming on a relative basis, quite impressively. Again, that's a thing where I'd say, like, if banks are making new highs, it's really hard to see that we're going into some type of crisis, market downturn, what have you. But again, we have to take things one day at a time, 1 week at a time. Biotech, this is where I mentioned earlier, sometimes with healthcare, there's parts that are defensive, parts that are offensive. Biotech's been a, star on a relative basis here the whole back half of the year. Then going into home construction, again, this is a subcomponent of discretionary. That's why in some cases discretionary hasn't necessarily been able to really get out of its way. And then metals and mining. If I'm going to look at material stocks, I like looking at metals and mining. Again, that's my own preference. This is good representation of gold miners, silver miners, base metal miners, uraniums, rare earths, steel, coal. Any diversified metals and mining stocks. So that's normally what I like looking at if I'm looking at quote unquote materials. Okay, now moving on. What I want to go over next is international markets. Now, I know obviously here in the U.S., we're very U.S. centric. Everyone looks at the Dow, the S&P, the Nasdaq, the Russell 2000. But here, we're just looking at the all world ex-US. This is effectively just a market cap index of everything outside the U.S. And up here, I've got the same type of chart where it's the international index relative to the S&P. Here's the international index, and beneath here, this is the inverse dollar index. So in a lot of cases, when we're looking at international markets, from our perspective in the U.S., a lot of the alpha that can be generated is effectively just as if the dollar's falling, typically international assets end up outperforming, and vice versa. If you get some pretty severe dollar strength, uh, international markets can lag on a relative basis just due to the currency conversion. So, here, yes, if international markets outperformed the S&P here year to date, yes, but if you look at this longer term chart, really, the only alpha the international markets were able to generate here this year was really just from the beginning of the year until, let's say, around mid-March. Now, really, and all that was as we were coming into the year, international markets had a really rough Q4. At least from our perspective, like being underweight, staying out of those things is at least what this was telling me at the time. So even from there, even though the international markets have outperformed the U.S. markets here year to date, a lot of that was really just if you go back here just as far as this consolidation, it really was just the international markets making back the kind of massive relative underperformance that they experienced in Q4 2024. And we've just been going sideways here since, March and April. So from that standpoint, yes, it was a very hot trade Q1. Since then, kind of, again, just, consolidation. It's still good to have some diversification, but this standpoint, it's kind of, we'll see which way this ends up breaking. A lot of it, I think, is going to have to end up doing with which way does the dollar go. Dollar sells off, you're probably going to get some strength internationally. Dollar strengthens, vice versa. Okay, so we're going to move on now from the equity markets to the fixed income markets. So what I'd like to show here is we're going to look at the 10-year Treasury note. So, when I'm looking at this is basically from my perspective, the most important benchmark, for interest rates or bonds in the U.S. This is effectively what, intermediate, excuse me, longer term rates, effectively what mortgages are based off of. They're not based off short-term rates, so we'll get into that here next. But one thing I like looking at, as far as trying to let me know where interest rates are heading, are looking at inflation break-evens or what the market's pricing in terms of its inflation expectations. So down here, these are inflation-protected bonds relative to, equal maturity treasuries. And, one thing that I found very interesting here is that if you go back and look at when the Fed started its rate cutting cycle in September of 2024, um, inflation break-evens did not continue going lower and actually bottomed. I know it's a little maybe hard to see here, but actually bottomed prior to 10-year interest rates bottoming. And, once the Fed started cutting, it was just kind of a one-way trade where inflation break even started ripping higher, rates started ripping higher, as you can see, going from 3.6 to 4.8. And really, though, we've just been kind of consolidating here in the tens for the better part of 3 years. The high in the tens effectively coincided with, at least again, the highs in 22 effectively coincided with the bottom of the market. On October 13th of 2022, there was a CPI number that came out that morning. It was in double digits. The S&P futures ended up selling off dramatically pre-market. Rates spiked up higher. And then, a little bit later, I think the market said, okay, hey, this is probably the worst things are going to get. And they ended up being right because after that, the rate of change in CPI started dipping down. And we had a pretty strong reversal that day in both the S&P 500 and interest rates. And that effectively marked the low in the cyclical bear market we had in 2022. So we'll go on here to well, let me just say, basically here, right here, I just think from this standpoint, all inflation break-evens are telling us is, they're heading lower. Interest rates have been following that, but at least right now, I'm not necessarily seeing anything in terms of like a major divergence is telling me one way or the other which way this is going to break. So next, we're going to look at, here's the tens again. I just want to highlight again that ever since the Fed has started cutting rates, we've actually had, intermediate and longer term rates go higher. So when they started cutting rates, we're at 3.62 on the tens. And right now, as of the close on Friday, I'm actually taping this December 21st, 2025. They did cut again. So rates right now are at 3.75. Rates are still significantly higher than they were when they started cutting. So what I want to show next is we're going to look at 2-year Treasury yields relative to Fed funds. Is what this black line is. Now, what the 2-year Treasury is, that's the market effectively saying where they think the Fed should be in terms of their interest rate policy. So if you can go back and look here, when the market started getting concerned, the Fed was going to go into a rate hiking cycle, the 2-year yield started taking off and got significantly higher well before the Fed started hiking rates. And then vice versa, the market, got up here closer somewhere between, 5.25, and priced in, okay, this is where we think the Fed's most likely going to end up stopping. And if you could say anything, the Fed's potentially, been a little, tight, here really ever since the beginning of 23. Now, right now, what this is telling me is that with right now where, the twos are, let's say, call it 3.5, Fed funds right now are between 3.5 and 3.75. The bond market, at least right now, is implying that they really only think we're going to end up getting maybe one additional quarter point interest rate cut here sometime in 2026. Now, we'll see what happens. A lot of cases the bond market isn't always right, but that's at least what it's saying right now. Moving on to let's just step back for a second. When I mentioned that the Fed can control short-term interest rates, but they can't control the long end, this is specifically what this is illustrating. Even though they've been cutting and short rates have been coming down, long-term interest rates have either held serve or been going higher. So obviously that's yield curve steepening. There's various factors going into that I'm not going to get into now. But moving on from fixed income, we'll go into commodities. Okay, so right now, this right here is just the S&P GSCI commodity index total return. So it's just a good broad basket of crude oil, Brent, gasoline, nat gas, gold, silver, copper, agricultural commodities, so corn, wheat, soybeans, and what we'll see here is just when oil got negative around the COVID lows, we've had quite the advance, and then since then here for a little over 3.5 years, it's just been one big consolidation. You've had times where you've had some rallies, sell-offs, and obviously crude oil, we can show here, which is, energy is the biggest, subcomponent of the commodity indexes. It's just been a pretty big downtrend, here ever since, spiking up here, when the onset of the Russian-Ukraine war began. Really where the action's been in commodity markets here in the last few years has been, precious metals. Here we can see gold, after really kind of underperforming the market here for, quite a long time. Gold, broke out of this big consolidation it had been in since September of 2011. Broke above a little over $2,000 an ounce and has been in a fairly large advance. Um, you know, Gold, again, for the most part, or sometimes it can be a risk-on asset, risk-off asset. Just a lot of times I'll say this, I don't trade correlations. I trade price and try to keep an open mind. I think, correlations can change. They change all the time. But here what I'd say is, gold, had a pretty strong advance. It can, topped out right around the time that the, uh, just like, sorry, I'm just going to zoom in a little bit. Topped out right about the time that the S&P bottomed, there in mid-April, had almost a 4-month consolidation and has had another advance. So from that standpoint, again, no comments on this. It's been, really good asset if you've owned it. Um, then we'll go back and we'll take a look at silver, which is another precious metal. We can probably go back. Let me make it a 3-year chart here. Again, silver, really from a alpha standpoint relative to the S&P, did nothing for years and years and years. Again, here finally, around the summer, broke out of this 38 level, and it's been just a, outside of some corrections, just a one-way trade here. Again, congrats if you've been overweight this. And next, I'll say, like, last thing I want to take a look at, again, just because everyone asked me about this, is crypto. So we're going to look at Bitcoin here. I'll say this, I thought Bitcoin around midsummer looked fantastic on both an absolute and relative basis. Clearly, this is why in some cases you have to keep an open mind. After it broke, here to an all-time high in mid to late July and then August, we had a really nasty reversal. Broke down on a relative basis to the S&P. Obviously, if you got risk mitigation methods, is where it was time to take them. And then Bitcoin went from 120, an all-time high of 126,000 all the way down to 80, and consolidating is trying to figure out which way it wants to go. Um, Last chart I want to look at, and this is effectively just kind of a bonus chart here of just something interesting I've noticed is that, as I mentioned earlier, the semiconductors right now have been the main beneficiary of the artificial intelligence trade that's been going on here since late 2022. NVIDIA, which is the largest component of the semiconductor index, and it's also the largest component now of the S&P 500 and the NASDAQ 100. NVIDIA, this is a chart of NVIDIA relative to the semiconductor index. So it's how is NVIDIA doing relative to the sector that it's in. So, what you'll see here is, very interestingly, NVIDIA relative to the semiconductor index topped out before the S&P topped out before the cyclical bear market in 2022. It bottomed, right around the time that the S&P bottomed in October of 22, and then since then has been in a absolute just rip-roaring bull market relative to the rest of semiconductors. And here for the first time, since ChatGPT was launched in late 2022, this is the first time you can start saying that it's making lower highs and lower lows. Now, that could just be some rotation, which would, within the semiconductor space. Again, but this is something where I'll say there's some good things, there's some cautionary things, some bad things potentially we're seeing going into 2026. This is one that I just find interesting. I don't know exactly what this means. Is this, saying, okay, well, hey, the AI trade's over? I don't believe that necessarily the case. We'll see. But again, it was something that I was looking at here in the last couple of weeks that I find interesting. So I'm going to stop, sharing my screen. And yeah, so obviously, thanks for, spending the time to watch this video, me reviewing some of the charts I found interesting here for 2025. As far as prediction for 2026, as I tell people, I have absolutely no prediction. I don't make predictions. It's my job just to basically take things day to day, week to week, and look at what a lot of these intermarket relationships and risk appetite ratios are telling me on a again daily, weekly basis and make decisions from there. So obviously, if you want to get a hold of me and discuss these things, I can be reached at my email's matt@jtmwilliams.com. My office number 703-782-3110. If you have any questions, please reach me. I'd like to wish everybody a very happy holiday, Merry Christmas, Happy Hanukkah, and wish everyone a great new year and look forward to talking to you in 2026.